Well, hello and welcome to Trading Blows from TraderX. Another busy show this week. Plenty to dig into, including last week's economic data out of the US and what it may mean in terms of the macro outlook going forward and also in terms of Fed policy implications. We'll have a similar discussion around the UK as well after the jobs data that we had out a little bit earlier on this week. And we'll also dig into the markets, why the dollar can't find a bid in the FX space, and whether the upcoming earnings season is going to be a catalyst for either the bulls or the bears to seize control of global equities. Without further ado, let's get into the show. So plenty to discuss as always. Let's bring in the panel. They will score points for a great response over the next 4 rounds. The threat of points being chalked off looms over them if any disputes are raised over their answer. It is International Dress Like a Recruiter Day today, as you can see by the gilet that is being sported here. And joining me on the panel this week, we have the world's loudest man, Arno Venter, now that we've turn his microphone down. Brian Paisey, who has thankfully managed to get rid of those dodgy sunglasses he was sporting earlier, and probably the only sensible man here, Ioan Smith. With the gents on the show, let's get into the first round. Right, let's get into the show properly. We will start with Arno this week. Now, as I said, we've managed to quieten him down a little bit. I want to dig into some of the US data that we had out last week. It was an interesting week and some mixed releases when you kind of digest it all in the round. Obviously, we had the pretty grim manufacturing data in terms of the ISM survey, the first payrolls miss compared to consensus in 15 months. But then you had a really strong ISM services PMI. So how do you kind of piece all these little jigsaw pieces together and come up with a conclusion and draw some signal from all the noise that we got last week, mate?
I don't think we can get a lot of signal from all of that noise, to be honest.
Next question.
We had manufacturing, like you said, coming in lower, services surprised higher. The jobs report was a complete mixed bag because we had headline non-farm coming in lower than estimates, earnings coming in much higher than estimates, and the unemployment rate coming in flat as expected. So a bit of a mixed bag all around. And I think, that just shows us what we've known over the course of the last few months anyway about the economic data. We've seen some things showing a lot of red lights and some things have recovered, like the housing market we spoke about. I think what I found most interesting out of all of that was actually yesterday's NFIB data, which the markets, obviously ignored. We once again seen a big move lower there in hiring plans for small businesses. And like we've mentioned many times, what's interesting about small businesses, we know that they're always going to be more sensitive to changes in the economy. And the fact that they are seeing, plans for hiring more people in the months ahead diminishing, I think that isn't a great sign for the overall labor market. It's been my view from the start of the year, basically, that the labor market will eventually roll over and push the economy into a deeper slowdown. Whether that will lead to a recession or not, only time will tell. But, timing that is really the endeavor that we have a lot of problems with. If you're trying to say that, oh, yes, it's going to happen this or then or there, that's where you get into trouble. And I think sometimes traders think that the big players out there, it's like they're sitting, at their desks with a button ready, and every time that the data changes, they make a pivot here and rotate and reallocate. But obviously, it's just us who are crazy enough to trade short term that do that, So I don't really think anybody will change their outlooks at all based on the data that we had last week. It was too much of a mixed bag. I think where things could be a little bit more interesting is with CPI a bit later today. This is obviously recorded before CPI. The focus will obviously be more fixated on the core measure as we've seen recently. But I don't really think that's the right way to go about it right now. Obviously, yes, core inflation is sticky, but core inflation normally tends to, follow a headline with a bit of a lag. So if we can see a headline coming in as expected, which is quite low, I think expectations is 3.1% from the prior of 4%. That's a pretty big deceleration. And I think, if we get anything close to that, the market should just continue with that view that, yes, we are seeing that disinflation process. We're on the process of that disinflationary environment. Everybody knew, coming into the year that getting from high levels of 8 or 9 down to 4 or whatever, that would have been the easy trip. It's getting lower that's going to be difficult. But again, I think there, as long as headline stays low and continues to decelerate, that core inflation will eventually follow suit. So I don't really think that will be a major game changer until we see a trend acceleration, which I think is unlikely. If we can see a 2 handle coming in with headline and a potential 4 handle on core, I think that could be really good for risk. I also think that could, put some additional pressure on the move we've seen in yields from the start of the week, where the markets does seem to be pre-positioning a little bit going into CPI. But again, if we see CPI coming in, even if we see it coming in above expectations, our prior number on headline was 4. And expectations is for 3.1. So even if we see a big beat, which is like 3.3 or 3.4 or 3.5, that'll cause some short-term volatility, but it'll still show inflation decelerating by about 0.5%. So I don't know I don't think the data last week changes much. And even though CPI can trigger some short-term volatility, I don't think that will really change the market's bigger picture view right now.
No, I personally make you right on that one. Ryan, I'm keen to get your thoughts as well. I mean, is this a case of now there's really nothing that can deter the Fed from raising rates at the end of the month? It's kind of 25 basis points locked in. Everyone goes off to their sun loungers, and then we see where we are at the start of September, I guess.
I think you're exactly right. And I think Arno's exactly right. So it's one of those, Arno's answered the question for everyone, I think. I'm struggling to see any chance that the Fed don't hike by 25. Obviously, that takes the rates up to 5.25, 5.5. Again, Arno exactly right. The NFP number that everyone gets all frothy knickers for. As we said on the show last week, unless it was a clear everything in line going the same way, leave it alone. And it definitely wasn't everything in line. Everything was messy, as the proverbial. Something that I did think, I'm a big fan of looking at revisions as well as the headline NFP. As always, a few people kind of missed that angle. And we had downward revisions of the past 2 months of 110,000. Which again, it just goes to kind of, what am I going to read from that? Nothing. But what you should take away from it is just more proof that NFP is just the most volatile, inaccurate figure known to man, apart from Chinese data, obviously. But
that's not volatile. That's just made up.
Well, it's just that we said it last week that NFP data is just incredibly messy at the best of times, and just these huge revisions, prove exactly that. If you look at the whole kind of gamut of data that was released, it was pretty much a mirror image of last month's report. And this just, it just shows you, like Fed policymakers aren't looking at NFP. They'll be looking at like kind of underlying employment data, but no one's looking at the headline NFP data. But just on the US data subject, obviously that is the topic. One thing, everyone's kind of bemoaning the ISM data, saying how shit it was. But the ISM services data was massively better than expected. I think it was 53.9 versus 50.3 expected. And it's beyond, and there's plenty of people, and plenty of much smarter people out there than me, low bar, admittedly, that often say that it's the services sector that's more indicative of the underlying, economic health of the US. We're also seeing new orders picking up on a falling prices paid measure, which again is deflationary. If the prices being paid to manufacture stuff is less, the feed through to inflation. I think prices paid was like a 3-year low. So that kind of rolls into what Arno was saying about in the CPI numbers, the inflation data is definitely going the right way. No one can argue it's going the wrong way. If you just block turn.
I'm sure someone would. I mean,
exactly. We're looking at headline and core coming month-on-month print, say around 0.2%. That'd be the slowest rise since 2021. Year on year for the headline, just over 3%. As Arno said, core just over 3.5. Anything below 3.5 for headline, anything below 4 for core, it's decent. So everyone's like soft hard landing, as a few of us said in a previous show. Well, 2 months ago or a month ago, what landing? It's like, but I think your number one takeaway from this segment of Trading Blows should be, don't ever just judge anything on one set of data. You've got to judge things over the course of 3 months of trending data.
Yeah, absolutely. And actually, your point on payrolls, I think it was the Fed's Goolsbee actually made it himself on Friday afternoon when he said, we're not going to read too much into one data point. We never will. That's not how we set policy.
Do our retail traders.
Yeah, exactly that.
No offense.
Ioan, I'm keen to bring you into the show. What are your thoughts on what happened last week? Obviously, we had that big divergence coming through between the manufacturing and the services sector, as Ryan alluded to, and that's obviously been going on for some time now. I know, miraculously, you made a good point there, Ryan. It's a miracle.
I'll see you guys later.
Do you reckon that this can continue for the foreseeable and we'll see manufacturing rebound, or is it a case of we're just waiting for the services sector to turn lower as well?
I don't know. I think it's like we said last week. I mean, we had that conversation like Ryan alluded to there, that like basically 100,000 plus jobs and like Kaiser Sose, like and it's like, well, you can't like judge one data point in isolation, and we've long had this conversation about like non-farm payrolls and how we don't look into it, or read too much into it. I'm sorry, but yeah, I mean, everything all the data points are very mixed. I think we're referring back to the ISM there. I mean, manufacturing. I mean, the last time it was this low, and basically had not led to a recession was in 95, 96. I mean, the others since then were obviously the GFC, like COVID, and probably the dot-com crash. But the economy's changed, right? So, I mean, there's a lot of the manufacturing base has been, transplanted to, Vietnam, China, whatever. So, maybe you should add more weight to services, probably a higher value added anyway. And then just to go back to Arno's point there on the NFIB data, on the flip side of that, I mean, if you looked at specifically, say, the JOLTS, I mean, the number of quits in that JOLTS data is key. I mean, if people are not quitting their jobs, it doesn't mean that they've got other employment lined up, but quits increased to 4 million last print. But, I mean, you can read a number of things into that. You can say, well, right, people are confident enough to go and find another job, or there's too many public sector jobs out there which governments are basically funding with issuance. And at the same time, coming back again to the point Arno made about yields and prepositioning before the CPI, I think everything to do with yields at the moment is not necessarily related to inflation. I think people are sort of, the market's got a handle on it. I'm not sure if central banks have a handle on it. But it's issuance. I think issuance is a big thing which is driving treasury yields at the moment. We'll talk about that in obviously one of the other sections. But, the Fed has already intimated that it's split on a hike and a pause was appropriate in June. But their baseline economic projection now is a mild recession, from, Q4 this year to Q1 next year. So, governments, they're trying to grow the economy by overspending, and then they tell us that they have to get inflation down to grow the economy. So, I mean, it's kind of laughable in a way. But then again, I mean, Ryan made that point again about, what sort of landing are we going to have? I mean, can we ever have a hard landing anymore? I mean, the worse it gets, the more policy response we get. So, I mean, that's basically where we are.
So can I just only because I just thought of it whilst my good friend Ioan was talking, but in terms of, and like we all agree that basically services provide an increasing amount of GDP, right?
Mm-hmm.
So is it possible, and I honestly just thought this just now, so it's very likely to be utter shite, but is it possible that it's now incredibly hard for sustained negative GDP growth as long as the service sector is growing as a whole? Obviously, because the service sector is growing in terms of proportion of the US economy, right? So does that mean if you were trying to kind of define a recession, it shouldn't be negative growth? Because in fact, you could have some very low positive growth, but it's still, for the economy as a whole, the economy's still shit. Because it's kind of, it's like almost like GDP derived from services is almost kind of stealthy GDP, because you look at GDP of Switzerland or whatever, it's all financial services. It doesn't really, it's nothing to do with the country itself, like Luxembourg, for instance, like that. Anyway, ignore me. I'm talking about.
Well, no, I was just going to say very quickly before we move on, this is where the US is slightly different from other countries, because everywhere else, technical recession, and in the US as well, it's 2 consecutive quarters of negative GDP, as we know. But the US, they've got the NBER, who are the sort of official arbiters of when there's a recession. And God only knows what's in their little black box.
Oh, give yourself a point. Go on, me.
Give yourself a little pat on the back. There we go. Right, let's move on to the next round. Right. I want to talk about the dollar a little bit, because it's been quite interesting over the last week or so. Obviously, as we just discussed, we had a bit of a mixed bag in terms of economic data. We also had a really big move higher, particularly at the long end of the Treasury curve. I think the 10-year yield was up about 20 or 25 basis points last week, as Ioan was alluding to there at the moment. We may as well start with you, actually, Ioan, given that you were making this point earlier. I mean, where do you think that Treasury is going to head next? And why do you think the dollar hasn't followed yields as you might expect it to?
Ioan, can you sit up, please? Because you're looking you're looking shorter.
He's looking shorter than you.
Yeah, I know. I'll make the jokes.
Have you had a haircut?
No.
Oh my word! Keep the hat on.
I better sit right up then. We've talked about issuance and how the Treasury's got to rebuild that general account. I mean, it appears that they're causing less tightening in financial conditions than everybody thought that they would. But the use of the Fed's reverse repo facility has declined, and bank reserves have sort of edged up a little as well. So conditions are sort of stabilizing a bit, but this issuance is massive, and I think that's having more of an impact on the dollar than most people sort of alluding to. And at the same time, I think the yen is obviously taking a lot of interest in the market as well. But like going back to that issuance, I mean, on Monday? It was 123 billion in 3 and 6 month bills. I mean, they came back to the market yesterday and it was massive. And today they've got, I think it was 4-week bills, and that's over 30 billion. And there's more to come as well. So I think people will be, sort of looking how issuance pans out, whether the demand is still there. I mean, I don't find it particularly interesting myself, where, you're looking bid deals and things like that, but somebody does.
We don't know who, but someone will.
Yeah, I mean, ultimately the equity market, they're ignoring the duration risk, right? Some have increased, their expectations, for interest rates to, the recovery in the economy. But I don't think it's that. I don't think the macro data supports the narrative for the higher Treasury yields. I think the decline in Treasury is pure and simply this massive issuance. I mean, last month alone, we saw the 850 billion. So that was the second largest figure in history. But with this supply pressure, they can't stop, because the fiscal deficit is approaching 8%. And another thing that, I mean, over the long term, what we've got to look at is 40% of the US national debt rolls over. So they'll soon be spending more on servicing their debt than they will on defense. Now, I think, the average investor probably doesn't have much of an idea on what could be on the horizon in terms of, heightened market risks. But, I mean, that chart that I sent you, or like if you haven't seen it, have a look at the visual capitalist chart on the velocity of interest rates. That's unprecedented. Most market professionals would, they'll be aware of the lag. But I mean, I think the question is, it will be related to their positioning then, at the right pivot points, because there are going to be a lot of risks down the line. But as we alluded to earlier, will there ever be a hard landing? But I think it's good to have these things in the back mirror anyway, just to keep an eye on.
Yeah, definitely. And as you say, when you do see it on that chart, the scale and the speed of the hiking cycle that we've been through and are still coming towards the end of really is staggering when you see it represented graphically. So yeah, do go and check that out. Arno, I want to bring you into the conversation. I mean, we've seen, just looking at the FX space, dollar yen this morning, this is Wednesday morning when we're filming this, trading below 140. Cable is moving towards 130. Euro dollar looks to have broken above the 110 handle. Do you think this is the sort of move that now might be starting to gather and pick up a little bit of momentum now that we're breaking through these key levels, or do you think it's gone a little bit too far too fast?
So I think going into CPI, we might have gone a little bit too far too fast. Look, I think fundamentally the dollar is a very tricky one right now. I think there's reasons to like it down and to like it up. On the bearish side, right. The fact that the...
Right, hang on a second. Arno, get off the fence.
You're not here to be like that.
Okay, so...
max long or max short, that's it. Otherwise, you get lost.
So on the bearish side, right, the Fed is expected to end the cycle soon, while others are expected to continue. So that's a negative. On the bullish side, the US economy is going through a little bit of an exceptionalism drive right now. I mean, it's looking much better in the US compared to anything else. And yet the dollar is selling off, which is a little bit of a weird one. So medium term, I don't know. I think if someone has to take a medium term view right now, it's going to be tricky because the dollar has basically been stuck in a range for the last 6 months, 7 months, 101 to 106. Unless we break out of either one of those ranges to the up or to the downside, we're probably just going to be stuck in this range. We also have summer liquidity to contend with. I think that is something to keep in mind as well. What can happen to see us breaking out of either 101 to the downside or 106 to the upside? Well, on the downside, we probably need to see the rest of the world recover massively, right? If we start to see a real positive growth shock developing in places like China, which influences the Eurozone, that can obviously create some additional pressure in the dollar. We know that from the dollar smile theory, that if the rest of the world does really well, the dollar normally does bad. On the upside, we probably need to see the US economy massively accelerate versus globally, even more than we've recently done. And that could be enough to see the markets, traded higher. There's also the other negative side of things. If the US economy does eventually roll over massively and we start to go into a bigger global slowdown, that is normally an environment where the dollar does well as well. But until we see either one of those two things happen, and as we remain stuck in that 101 to 106 range, having a shorter term focus makes the most sense right now. I don't see a lot of scope for being either long or short now from a medium term perspective, but short term from a sentiment point of view seems to be good. Now, in terms of what that means for CPI, I think that's where it gets really interesting this week. Obviously this takes place.
Be careful, Arno, because this could age terribly. I said be careful because this could be about to age terribly by the time.
Yeah, so in terms of CPI, the way that I will be approaching this, and again, this happens, we're recording this before CPI, but if you take a look at the amount of downside, right, I think the market's inclination will be to look for shorting opportunities in the dollar because we had a good ADP, we had a very good ISM services, the jobs was mixed. Based on all of that, but with earnings obviously super high, based on all of that, the move lower in the dollar has been very, very aggressive. So I think the markets will look at that to say, okay, cool, if inflation comes in lower, we just continue to short the dollar. I do think that's going to be a little bit risky, though, because this looks like a ton of pre-positioning. And if this is, classic buy the rumor reaction from the markets, if we get inflation coming in just a little bit lower or, in line with expectations, that could actually see a knee-jerk reaction to the upside of the US dollar. So I would prefer to... if I'm going to be looking for shorts in the dollar, I would need to see a 2 handle on headline and a 4 handle on core as a bare minimum to look for additional downside. To the upside, it's going to be tricky though, and again, a short-term view will be preferred here because let's just say we do see CPI beating estimates. Let's say we print at 3.3 on the headline or higher, or something like 5 or 5.1 on the core. That'll be a surprise for the markets, and that could see a short-term recovery move higher for the US dollar. The risk is that type of trade will most likely be a short-term trade for you because unless we see a move above the prior prints, which is miles away for headline, and a little bit further, not so far away for core, if we don't see a trend acceleration, then it still means that inflation is slowing down, and it still means that the Fed's path will remain intact, and that should be dollar negative again. So if there is an opportunity, 2 handle, 4 handle, I'll be looking for short-term downside. If it is a beat, short-term upside for the US dollar, probably versus, the yen, just purely looking at pre-positioning right now. But again, that'll be a short-term trade if we don't see a trend acceleration because we're looking at a 0.9% expectation for a headline. So even a big beat like 3.5, that could see short-term upside for the dollar. But there's still going to be a 0.5 percentage point deceleration in inflation, which should be a negative. So it's going to be a tricky one, but short-term focus is the way to go right now for the dollar.
I never thought I'd say this, but let's go to a man who might bring some clarity to the situation.
I'm going to raise 2 points. One, I'm pretty sure Ioan's got a bet with someone that the more times he says the word issuance, he gets more money. Because you've got to be long Ioan's own issuance word count. Secondly, Arno caveated everything he said at the start with, we're recording this before CPI.
Yeah.
This is coming out after CPI. So why the fuck are you telling people what to do on the CPI number?
well, I'm saying what I'm going to do.
It's too late. It's when this comes out, it's already gone. You get that, right? So if I was being really pushy, I would say you should remove all the points that Arno incurred telling people how to trade CPI because it was an hour ago.
Look, it's either going to be right or wrong, and they'll know that.
It's brilliant. Yeah, it is.
Right, well, what we'll do is next week, I think you're around, we'll assess how you did, and then we'll lop all the points off if you got it wrong.
Anyway,
that's a good way.
Now, So firstly, right, US dollar. I think is that what we were talking about? I can't even remember anymore. The whole dollar, bearish dollar at the moment. I think it's a classic example of better than expected data, i.e. inflation coming down, is bad for the dollar. As much as people like to hate the idea of it, good news can be bad for markets, bad news can be good for markets. Obviously, it depends on the market, right? It is a thing. So people trying to deny that, just warped and misguided. Ioan seems to have disappeared off my screen. Look, there's no getting around it. The dollar's on shaky ground. I personally am still bearish the dollar. I think it's kind of quite important to recognise the fact that when we talk about something being sold, obviously in this case the dollar, it's not that dollar disappears. It's not like that dollar ceases to exist anymore. It
goes into issuance.
Oh, well, this is it. Well, exactly. There you go. But it's like, we're talking about the dollar being sold off and the dollar price, but where are those dollars going? Where's that apart from issuance? And it's a thing it's one of those kind of, when you think about it, it's very obvious point, but it's also something that many people do miss because they're trying to analyze too kind of concisely. I've seen some people saying, dollars being sold not just for issuance, but do I get 100 for the issuance? But also to fund the purchase of Asian equities. I thought that was quite an interesting point to raise. It's obviously one thing they're obviously buying with it is the sterling.
God.
Inside joke there, inside joke.
Very inside joke.
Yeah, so I know that, what can I say that the guys haven't already said? Not much, but I'll try anyway. I'm still bearish dollar. As Arno said, I think any knee-jerk reactions on the CPI data, if we do get a knee-jerk higher in dollar, I think it'd be a selling opportunity for those looking for longer run trades. It's subdued summer markets, but that doesn't mean the dollar isn't also looking to continue its trend lower. That's pretty much all I got.
Good stuff. Right. Well, let's move on to the next round and something Ryan definitely won't be bearish on. Right, so I want to talk about the Bank of England and the UK labour market data, and that noise you hear is Dick Matthews exploding as his blood pressure goes through the roof. It was a pretty grim UK jobs report, actually, earlier in the week. Unemployment up to 4%, and I'm now going to say something that you'll only ever hear an economist or an analyst say, which is that earnings growth was too high at 7.3% year on year, which is actually equal to the record pace that we saw during COVID, when, of course, all of the data was distorted by the various job losses that were going on at the time. Ryan, we'll start with you again. What are your thoughts on the data and also on what the BOE do next? Has this sort of just nailed on another 50 basis point move at the start of August?
Well, I think it's only fair that I mention that I've been bullish cable, the sterling, since...
you say that more than I say issuance.
He does, doesn't he?
Well, mate, if no one else is going to cheer me winners. So
I tell you what, I'm going to get you a T-shirt with disclaimer on it. Let me tell you.
I'm bullish cable. The sterling.
Ryan was bullish cable when he came out the womb, I think.
Bullish cable since 1980.
All right, you're going to let me ask me a question?
Come on.
So this follows on perfectly from what I said on the last question about bad data being good for some markets. Earnings data is obviously a good thing, but it also means the inflation data is awful at the moment for the UK. But that's driving cable higher, the sterling higher. It's been great to be long, but let's not confuse to be long sterling. But let's not confuse that with the UK economy being all sunshine and lollipops, because it's definitely not. It's sterling best G10 performer of the year. You could say part of that is because of how bad the Bank of England have handled things. So are they going to start handling things better? Probably not. I hate central bank bashing, but other than the Bank of Australia, Royal Bank of Australia, they probably are doing the worst job. But what else can they do? I think there's 50 basis points on the cards hike. I don't think we'll be going much higher after that, because I think we are starting to see cooling inflation signals coming through, and it's this also, remember that inflation isn't just a one country problem. So if we get cooling inflation in Europe or the US, it will feed through to cooling inflation in the UK, and we definitely are seeing cooling inflation elsewhere. Obviously, we've had a few figures out recently that are kind of popping up, saying a little bit rising into. I think the Spanish inflation data kind of picked up a little bit. But anyway, my biggest concern, if you are long sterling, apart from cooling inflation, is it's a massively overcrowded trade. It's now. It took a while for it to get like this, but I think last week Citigroup announced that for the first time since 2020, their positioning kind of metric is max long sterling. And we, as Michael said, we're kind of broaching that 130 level. Like it or not, these round numbers do matter to market participants, especially some real money participants. So if you've been long for most of the year, hello, this would be a great. And I hate saying this, but this would be a great time to start booking some profits. If you haven't already. Would I be short sterling? Never, ever. If it comes off, it's just another time to buy it, right? Just keep averaging. I'm not going to try and guess what the Bank of England are going to do next, because quite frankly, the Bank of England don't know what they're going to do next. So it has to fool's errand. If you are long, be careful. Remember that good economic news is going to be very bad for sterling. Just stay long, but keep it tight.
Well, sage advice
Oh,
there.
hang
As
on.
always.
Quick question. Can you trade, is there like a sterling index, like there is a Japanese index on Pepperstone? I genuinely don't know. Is there like a GBPX?
I don't know.
Oh, he doesn't know.
You know that pat on the back I gave myself earlier? I'm going to have to take that away now. I will find out and report back. Ewan, what are your thoughts on the data that we had? I mean, that rise in unemployment, obviously, we were 4, came down to 3.8, back to 4. Is this now starting to, is this going to be a trend, or is this just noise that's in the labour market numbers?
I think a lot of the focus on wages at the headline level. Let me answer the question.
Is it to do with issuance?
It's an issuance of data, yeah. But I think what a lot of people seem to have missed is that the labour market slack is actually increasing. The unemployment rate is actually above the MPC's estimate of the equilibrium rate, and that's for the first time since mid-2021. Job vacancies dropped, almost 100,000 in the 3 months to June. So that was the largest drop since January 2009. You see Arno throwing his arms up then.
Yeah, I saw that.
I mean, this is my notes. I mean,
Finally, it's happened to him. Finally.
Yeah, I mean that 20% drop, eventually will translate into fall in employment, right? So wage growth has way too much momentum at the moment, but it does lag labour market slack. But at the same time, and we keep, we're focused on wage price increases and everything as well. But it's not necessarily keeping up with inflation anyway. So, I mean, the ONS, their preferred number is CPIH. But I mean, if you use CPI itself, then real wages actually fell almost 2%. So I think you have to caveat a lot of this data with the underlying trends that people are not necessarily focused on because they're only looking at the headline numbers themselves. Obviously, there'll be a lot of focus on mortgages, but I think a lot of that will get pushed out to like end of 2026. And there's a lot of water to pass under the bridge before then. The decline in house prices is interesting. I think a lot of people will be focused on that. But again, policy response in this country when house prices fall, I think you do have a sort of a degree of safety in that regard, given the amount of investment that's in property itself. But ultimately, I think what it means, I don't think the MPC need to act as aggressively as the markets are now pricing in. Obviously, the Bank of England's only mandate is inflation. So, but it's and we've argued for a long time now that interest rates are just a poor tool for for containing inflation as it is. So, I think at this stage, what's 50 basis points going to do? I mean, we're already at a level where people are feeling pain. We all feel pain, but ultimately they're just pushing on a string with with rate hikes at this stage. So, and people have priced it in, so I don't think there's going to be much movement on expectations front.
Just quickly on UK issuance, so we just had a 10-year gilt auction which came in at 4.595% versus the previous 4.351%. So
the pound went down. Still, cable went down.
All about the issuance, mate. All about that issuance.
I'm telling you.
Right. Before we turn this into like trading gilts rather than trading blows, let's get on to Arno. I mean, Ewan seems to have stolen all your notes, Arno. So I guess you haven't got a lot to say on sterling or on a BOE.
Yeah, I mean,
and on to the next question.
Long story short,
if that's impossible for you,
yeah,
I think pound's run is starting to get really fatigued. Yeah, we tilted more bearish. Was it 4 weeks ago now? 3 weeks ago now? we haven't been, too keen on just jumping in on the bandwagon and shorting it. After yesterday's wage data, finally, started to trade some basket shorts on short sterling. Right now, I just think the picture is too negative. Like Ryan said, even though sterling has done really well, the economy, and especially the forward-looking outlook for the economy, is just getting bleaker every time we get data out. What was interesting about the jobs data specifically, single monthly unemployment actually jolted up to 4.3% versus the 3-month average of 4%. I think it was Samuel Toombs out making that observation, saying it's actually up to 4.3%. And that measure that
one should follow. Sorry, just quickly, Samuel Toombs is someone that everyone should follow.
Absolutely, especially with data, on the UK side. So the other thing you noticed was that measure that the BOE is so super keen watching recently, that vacancies to the unemployment rate, that went down from, I think, 0.83 to 0.77. So that's something they're going to be taking notice of. However, we know they are so. How many times have we heard Bailey say second round effects in the last 8 months?
Nearly as many times as Ioan says issuance.
Issuance, exactly. So, they're going to be super focused on that wage number, and maybe that keeps a 50 on the table. But we've got CPI coming up next week, right? So I think if it's a low number, sterling goes down. If it's a high number, sterling goes down. And the reason is, lower number should see some of that interest rate froth coming out. If it's a high number, it's just once again more negative for the economy. So I'm holding to the view of sterling short. Happy to hear that the long-standing bull, is getting cautious at these levels as well, referring to you, Ryan. So, if those who are very long start seeing risks of some, correction, then, that's probably a good time for bears to step in. So already short sterling here from yesterday. We'll see how it pans out. For me, looking at the positioning is massive. Like Ryan said, was it Citi? Ryan who said that they are max long now?
Yeah.
If you just take a look at the CFTC data, now, yes, that's only futures. But if you look at the last 52 weeks, we're at the 98th percentile on the long side. Now, that is incredibly long, incredibly fast. And I think what's kept sterling higher is more speculative trading than anything else, because nobody, well, not nobody, but many few will argue that the fundamental picture is positive for sterling right now. Fundamentally, economically, it's looking negative by the data point. And it kind of seems like, sterling has been running on this speculative train, and eventually,
more buyers and sellers, man. More buyers and sellers.
More buyers and sellers for now. But I think that's going to change. That's going to change. I think, my view is still bearish sterling. Until how long
have you been bearish sterling though?
For the last 3-4 weeks now. We haven't been trading it perpetually, but buyers definitely shifted. But now we are now shorted. Yeah.
I was going to say both Arno and I are so far underwater with that trade. We're you can't see us anymore. In any case,
that term, like more buyers and sellers, is the worst term in the market.
Oh yeah, of course
it is. I hate it. It's horrible. And it's also like it's mechanically impossible. But never mind, we could talk about that all day. Let's get on to the final round of the show. Right, I want to talk about equities, and I want to talk about earnings season in particular, because all the fun of the fair in terms of corporate reports kicks off again later on this week. We've got some of the major Wall Street banks reporting on Friday. I think JP Morgan, Citi, Wells Fargo kicking us off, and then we get full steam ahead into the big tech earnings in a couple of weeks' time. I'm reliably informed by the good folk over at FactSet, who project that earnings are going to fall. I know that I always struggle with that one. They are that earnings are expected to fall 6.5% year on year, which would mark the biggest fall since the middle of 2020, which was obviously when COVID sort of first hit the markets. Arno, what are your expectations in terms of earnings season? Is this something we should be focused on and paying very close attention to, or is it all just going to be kind of noise that's short-term volatility, but longer-term doesn't matter?
Yeah, probably. I mean, the thing about earnings expectations are that they are known beforehand, right? So there was a lot of fear in the quarter one earnings when we got it. And it was all just earnings recession everywhere, right? The theme was earnings recession, earnings recession, earnings recession. We got earnings, which was, not amazingly, fantastic, but it wasn't as bad as expected. So if everybody is expecting year over year to go down, 6.5%, even if we get that, it's probably not going to matter to the markets because it's already expected, So when expectations are that bad, it takes something far worse to really surprise the markets on the downside. I think what could make this quarter slightly different to quarter one, for example, is that this time around equities are already up big time, compared to last time around. We've got the S&P up, over 15%, the NASDAQ probably close to double that. So equities have seen a lot of good news priced in already, which is something I think is very different versus the quarter one earnings season that we had. We're getting to a time now when there's some interesting developments in volatility. Another good follow on Twitter is Chris Sidiel. From a volatility perspective.
Yeah.
He had some very, very good insights.
Also a very nice guy.
Okay, great. Yeah. So
just
they had some very good information out on spot volatility beta, where they said that there is now more vol sellers than ever before. The data that they've seen recently has literally been, off the charts. And what they reckon is that the next time we get a type of vol surprise, doesn't matter what it comes from, whether it's going to come from earnings or from data. They say that the reason that you connect to it won't matter, but the next time that there is a little bit of a vol surprise, he said in their analysis that the size of move will catch a lot of participants by surprise because there is a crazy amount of vol selling taking place right now. Obviously, there's been the volatility market, the availability for traders and investors and institutions to trade and access vol derivatives have skyrocketed. And he says that's a danger in his mind. So if there is anything that sparks uncertainty, it's like a very stretched rubber band at this stage, which could see volatility spike. And again, everybody will then point to, the VIX saying that it's that catalyst that caused it, or it's that catalyst. But he says that the catalyst right now is irrelevant. Just take note that things are looking a little bit scary right now. There's also something else to consider. I think it was meant to Q out in the week, who had a note out about VVIX, obviously the volatility of volatility, saying that what they are seeing from not just the beta skew, but right now looking at VVIX, they say that it's starting to cluster to the upside.
Sorry, Arno, can we just have a translation into English for our viewers and me and Ryan?
Okay, so
what the hell?
Okay, so
you're speaking in code.
So on the first point, right, there's too many vol sellers, which means that if something spikes vol, it can spike up massively. The other thing that's bad right now, or cautious for the markets, is that when you look at the volatility of implied volatility, it's starting to cluster to the upside. Now, what that normally tends to show is that there's a higher probability that vol wants to go higher as opposed to staying suppressed. Right. So that's a risk. Again, feeding into that thing that if earnings does, for whatever reason, come out slightly worse than expected, even though that shouldn't matter in a normal environment when you're already expecting, negative 6%, if we do see some of those like big AI names suddenly start to surprise to the downside for whatever reason, with all of that froth priced in, that's a real danger, I think, for equity. So I'm not concerned about earnings season or really the numbers. I'm more concerned about if something does upset this market and volatility starts to run, that could create a lot of pressure on equities in a very short space of time. And we need to be ready for that type of vol, explosion in the short term. Again, the trigger might be earnings, it might be data, but going into earnings with where equities are trading, I think that's a real risk that you need to watch if you're long equities right now.
Right. Well, that's the PhD take on the equity market. Let's go for the working man's take with Mr. Ryan Paisey.
That's probably the very politest way you could have put it.
I mean, I use the term working in the loosest sense.
Well, I don't know what you're on about. I think Arno made the points that I understood that Arno made. I thought they were very good points. There was plenty that I'm just going to nod and wave and say yeah. I think something to kind of lead on from a couple of things that kind of Arno kind of mooted upon was the fact that, do you want to be right or do you want to make money? It shouldn't matter why you think, well, like as Arno said about, it doesn't matter why the volatility is where it is. Just, as long as you can make money from the situations, that's all that matters. Let's be honest. Like there is a difference between being right and making money. And it's very critical that we understand that. And again, as everyone is, well, I said, as Michael and Arno said already, the overriding consensus is for poor earnings and conviction. But the conviction of that, as always, and conviction seems to be getting lower and lower on basically everyone's views at the moment. But in terms of the FactSet earnings estimate, obviously lowest since 2020, I think something that's kind of quite interesting is the fact that it keeps getting revised lower. I think in March, we were estimated at only 4.7%. It's now, what was you said, Michael? Was it like in the minus 7%? 6.5%. So it's clear signs that the analysts are becoming increasingly pessimistic, which obviously then opens up another can of worms, because is it like, analyst opinions driving other analysts to also follow suit, which kind of you get so we talk about overcrowding of a trade, you also get a kind of overcrowding of analyst opinions, which we do see more and more. So that's something to bear in mind. Next week we kick off obviously full blown with the earnings. Well, I think we've got JPM, Wells Fargo, Citi next Friday. Or is it this Friday?
This Friday.
This Friday. Yeah. I think so. By the end of August, by August 7th, we'll have 82% of S&P firms representing 80% of the market cap will have reported by 6th of August. So we're talking 3 weeks. It's going to be a very busy 3 weeks. As Arno alluded to at the moment, Vol is poised to do something. So there's going to be a lot of catalysts, and keeping it very simple, catalysts are what it's all about, right? I do think it's kind of interesting that there's S&P 500 revenues are expected to post no year-on-year growth for the first time in 10 quarters. But saying that, does this all mean that we're at peak bad news, or just like we're laying that foundation for the bottom of like the trough? And as we know, stock market investors are forward-looking. So, and I know this is going to sound like a ball-talking bullshit, but you can make a very good argument for the fact that bad earnings, if we see like surprisingly bad earnings, that it will, and we'll see like a knee-jerk reaction, say in equity prices, that will be seen by many and by some very big money investors as this is the low point of the earnings cycle. So, which is bullish for equities, because then they start scooping equities looking forward. They're looking like 5-7 years out. Also, on top of that, if we do get better than expected earnings, that will scare the living shit out of people that are still holding on to cash that aren't invested in equities already. So then that's going to force their hands. And let's be honest, if you are a fund manager or whatever, and you're not already max long equities, you're underperforming the market, right? We spoke last week about some articles coming out about the reason why Apple was taking a secondary bid was because you needed to own Apple if you're going to have a decent hedge fund, basically, at the moment, or a decent performing hedge fund. So, and I know this sounds awful, but I'm struggling to find a bear case for regardless of what the earnings come out as.
Just to quickly add on to that, you say that from a cash perspective, there's a lot of people that's going to be scared. I don't know how many of you caught that Bloomberg article that was out, I think it was 2 days ago, where they said that based on the first half performance that we've had in equities, the analyst community is probably the most bearish they've ever been on a H2 outcome. So everybody is expecting that all of these gains, or a lot of it, will disappear. But like you're saying, if we see earnings coming in strong, all of those players that are now not invested because H2 will be weak, I mean, it could be a
just on that point about the strategists, I think it's only about 6 or 7 times in history that they've all been negative on H2, and every single year that they've all been negative as a consensus, the market's been up.
Oh, that's right. Give him a point for that. I love that one.
You can have a point for that. Actually, why don't we bring him in? Go on.
Can I just say that, because I've got one good trade to put on.
Go on.
Get long the number of times AI is mentioned in earnings calls.
Oh, 100%. That is almost as guaranteed a winner as the long Brussels caterers trade of the Brexit era. Ioan, let's wrap up the show with you, mate. Obviously, as you say, strategists have almost never been as bearish as they have now. Are they going to be right?
Well, let's just go back to the point that Ryan made there about cash on the sidelines. I think it was interesting, the Morgan Stanley data last week, where I think retail had bought something like 7 billion of equities last week. That was the highest number since about 2016. But it looked like hedge funds had basically trimmed their exposure to global equities. So, but having said that, I mean, it looked like the retail appetite was still down about 60% compared to the years between 2016 and 2022. So there's still a lot of money that can come into the market there. I think going back onto the earnings front, I mean, like you said, the banks, I think what we should be looking for is how those unrealized losses are doing, along with loan balances and basically total deposits. But aside from that, I doing this for years, I mean, earning season is exactly the same. It's always lower and beat. That's all it is. You say that FactSet looking, was it 6.5%?
Yeah.
Again, this isn't a new game. I mean, and like Ryan said there, was it the overall S&P decline in revenue for the first time since, was it 10 quarters?
Yeah.
Yeah, I mean, ironically, earnings don't have to be that strong going forward, right? I mean, as long as they're higher than consensus, then it doesn't matter. The melt-up will continue. I mean, I tracked this for years and years, and the amount of times that analysts would move like lemons to cut estimates, those estimates come down, and the numbers come out, and then everybody seems to have forgotten that the numbers have been cut anyway. So
let's not forget that analysts kind of if they are bonkers wrong, it's noted by many, and it's also it goes on their CV. It goes on their discography. So so it's a lot of times the easy course of action is just to follow the crowd.
Right, exactly. And like an easy way to see that is basically the number of companies that beat estimates each quarter, regardless of economic conditions. Right? I mean, since 2000, roughly 70% of companies have regularly beat estimates by about 5%. I mean, that number would be much, much lower if analysts had held to their original estimates. So that's the game that they play. While earnings season is a circus at the best of times, especially how they cram everything into a Thursday. I think that's what we've got to focus on. We've got to remember or keep in mind that analysts are constantly revising their numbers. So most of the time it's down, and when the numbers are released, they beat, and the market goes, oh yeah. But ultimately, we can look ahead from there, and we can say, the Fed is they're intent on slowing economic growth, so that they
for the sake of an extra point to beat me.
He is, isn't he?
but I mean, with the Fed in that mode, it's only logical that earnings will decline anyway. But prices have got to accommodate lower earnings to reduce the current valuation multiples in this case. So doesn't matter really.
Absolutely. Right. Well, with all that said and done, let's get on to the final board.
You.
Ioan managed to speak. In case anyone hadn't realised, Ioan managed to speak long enough there to win the show. So congratulations, mate. Good tactic, that one. Right, I think Ryan's come back, so we'll wrap up the show there. Thank you very much, as always, to the gents for joining me. Arno Venter from down in South Africa, Ryan Paisey from PiQ Suite, and Ioan Smith as well. Also, thank you to Kyriakos for bringing this together as well as he always does. If you've enjoyed the show, drop a like on the video, leave a comment, let us know how you're trading the markets, and we'll be back in a week's time, and hopefully Ryan will have cheered up by then. We'll see you then.